All right, everybody. What's up? What's up? What's up? Welcome to our YouTube live webinar. Glad you're able to join us this evening. For those of you that are able to join us, welcome to our session where our plan tonight is to talk about momentum indicators, how we use momentum indicators, what we use momentum indicators for, and then how do I use them inside of counter trend trading. So the important thing to think about there is, how do we define trend? And really that's kind of going to be how we start, right? We're going to start with, how do I define trend? What is trend? How do I use it? How do I know what to do with it? And ultimately, what's the best thing that I can do when I'm identifying trend, right? So that's kind of the goal, and that's really what I want to start with today is really taking a look at it from a trend perspective. So if I could real quick, I just want to make sure that you guys can hear me and see me okay. So just go ahead and type in the chat box if you will. I'd like to know kind of where you're from, right? What part of the world are you coming to us from? Where are you watching this video from? And then also, what is it that you're trading? Are you doing futures? Are you doing options? Are you doing currencies? Are you doing stock? Heck, are you doing Bitcoin? What is it that you're out there trading, and what is it that you're out there doing? Because it kind of helps me to kind of guide what I'm looking at. So we're going to go tonight. I have allocated about 45 minutes. Oops, dropped my pen. I've got allocated about 45 minutes to an hour, but we can go shorter, we can go longer. It really is going to be depending a lot on you. So looks like I've got Frank coming at us from San Antonio as a futures trader. I've got a Forex trader. Looks like I've got another futures trader coming in there. Wonderful. Okay, good. So that kind of gives me an idea of what you guys are out there doing it. So, hey, Jack, good to have you in, man. All right. Greg, good to see you in beautiful Houston. I'm in Houston myself, Greg. I'm right down the road, brother, right down the road. So Steve in New Jersey, great, awesome. Well, hey, do me a favor, keep talking a lot in the chat box. We've got so I'm here to answer whatever questions you might have in the chat box. I do my best to kind of keep up. And then for those of you that have questions that I may miss, we have Mike, who's our support extraordinaire in-house from tradersarmy.com. He's going to be there to also answer any questions you might have. So I'm going to go ahead and share my screen. Let me turn my screen sharing on so that we can start kind of going through this thing. So let me make sure I'm sharing the right screen. I think I want to share. Hold on just a moment. This thing does take me a little bit to make sure that I'm sharing the proper monitor. You can see my trading workstation. So, by the way, the workstation that you're going to see me utilizing is Thinkorswim by TD Ameritrade. So I use Thinkorswim by TD Ameritrade. That does not certainly have to be the platform that you guys use. I have always felt like they do a pretty good job for me, and so certainly you use what works well for you. But you should be able to see my screen here in just a little bit. So trend versus curve. Yes, we will definitely be able to talk about trend versus curve, my friend. So let's talk about that, right? So let's talk about trend and curve for just a minute. Before we dive into trend, the thing we need to consider, almost more than we need to consider trend, is time frame, right? We need to consider time frame, and we need to consider, the time frames that we're working off of will help to determine what our trend truly and really is, because time frames definitely matter. So whenever I'm trading, I'm always going to be looking at multiple time frames, right? So when I'm looking at a time frame, let me just kind of clear this out. I'm going to use my drawing angle here. So I am always going to use, I primarily am going to use a major time frame. Okay. Now, my major time frame is essentially what tells me, am I a buyer or am I a seller? That's really what the major time frame tells me. Am I a buyer or am I a seller? And then my minor time frame is where I'm going to execute the trade. Okay. My minor time frame is where I'm going to execute the trade. Now, the reason that I have these separated, right? Now, my major time frame, if my major time frame is a 240-minute chart, right? And for those of you that are trading futures and Forex, 240 minutes is 4 hours. Well, then my minor time frame that I'm going to execute that trade on is a 60-minute chart, right? Now, if my major time frame is a 60-minute chart, my minor time frame is going to be a 15-minute chart. Right. And so I'm going to be able to go from the bigger time frame down to the smaller time frame. Now, this bigger time frame, which tells me, am I a buyer or am I a seller, is what we're concerned with today. That's really what I'm going to concern myself with today is, am I a buyer or am I a seller? And there are a number of ways to determine trend. So we're going to talk about a couple of ways to determine trend. One way to determine trend is going to be simply using moving averages. Okay, we're going to talk about using moving averages to determine trend. Second way, we can talk about trend lines. Okay. Third way, we're going to talk about swings. Those are the ones that we're going to talk about. Moving averages, trend lines, and swings is 3 ways to determine trend. Because those 3 ways are really the ways that most people do. Now, when I'm using moving averages, I'm going to primarily be using simple moving averages when discussing ways to identify trends. So let's go into one of our markets, and let's use, in this case, let's talk about. Let's use a stock, and let's use no, we'll use, actually, let's do this. Use the Euro USD. So here's the Euro USD, right? And we're going to use the Euro USD on a 4-hour time period. Now, when I look at the Euro USD on a 4-hour time period, let me remove all of these drawings here because I've got some older drawings on the chart. The first thing I'm going to do is I'm going to throw on a moving average. Now, what moving average would I want to use? So I'm going to throw on a simple moving average. Let me see if I can't find it here. I think it just might be under moving averages. There we go. We'll use 2 lines. And I'm going to use a 50 and a 20 period moving average. Now, the reason I'm using 50 and 20 is that they're the most common ones that are used in the use of moving averages. Okay. Now, when we use a 50 or a 20 period moving average, the idea is that in a trending market, it will be using one of these averages as major levels of supply or demand and kind of bouncing off of it. And there's a lot of people that use that as a school of thought. Now, that typically works better when you use it on bigger time periods, right? So, for example, if I go to the daily time period, that Euro USD really does look to be using the 50 period moving average as a trend defining tool. Now, in its most simple form, there are many, many investors out there in the world that use a moving average to determine trend. And that's okay, by the way, I think, for investors. So for those of you that are investors out there and you're not necessarily looking to be traders, if you want the easiest way to define trend, right? So if I'm talking to somebody who wants to know nothing about trading and they just want to know about how markets operate, I may tell them, listen, if you want the simplest, easiest way to define trend, then use a big picture time frame, a weekly chart, and if we're above the 50-week moving average, you're in the market. If we're below the 50-week moving average, you're out of the market, right? It's the simplest, easiest way to define trend. Now, is it going to get you the best results? Absolutely not, right? You might get better results many different ways. But what it will do is it'll get you a little bit of a trend definition. Now, as traders, I don't feel that this is a very good way to do it. And the reason I don't feel it's a very good way to do it is because when I slide to the 4-hour chart, going back to something here like the Euro USD, we have way too many violations, right? Way too many violations for this to be something that can be used as for any validity. Okay. So when I talk about my three different, styles, if you will, for me, moving averages, I would say are useful for investors, but not necessarily useful for traders. Okay. So I do believe that those have a lot of use for investors. So if you're an investor and you wanna use this is good. For me, this is good on daily, weekly, and monthly charts, and really nothing less than that. That's what I would say. Daily, weekly, and monthly charts, but really nothing less than that. So that's what I would say on the moving averages. So now let's talk about trend lines. Let me check. I want to check the chat box real quick if you guys have any questions on that. Hey James, good to have you, man. Welcome. Yeah, I did do an event in Hartford a while back. I do remember that. I think that was my only time ever in Hartford, James. I do though miss the Whalers. That was one of the greatest logos in all of sports. All right. So let's talk about trend lines next. So let me get rid of these moving averages and let's change to talking about trend lines. All right, so let's talk about trend lines. Now, oftentimes you will hear people talk about trend lines. And the rule on trend lines is, first of all, you must include the wicks, right? So if I were to draw a trend line, it takes 2 points to confirm a trend line, 2 points to form a trend line, and a third to confirm it. Well, what if I use this as my trend line, right? Well, what if I use this as my trend line? No. What if I use this as my trend line? See, what's the inherent problem that you see in trend lines like this, right? What do you see is the inherent problem in using trend lines like this? What do you guys think? Right? Because there's definitely problems in using trend lines in that way, right? Like for example, I like going back to the S&P because it's a good one to kind of go back to, right? So in the S&P, I could certainly draw this trend line, right? Very easily. But I could also draw this trend line and say, oh, look, we're in an upward trend. And you guys are exactly right? You're putting it in right on the nose. It is too subjective. It is subjective to how you draw the lines. And that's my problem with drawing trend lines, is that there is an amount of subjectivity that I think makes it an invaluable way to draw trends and to identify trends. So for me, when I'm identifying trends, trend lines are, I don't use them. I don't use trend lines. I 86 them. Now, I will use trend lines when I'm identifying chart patterns like triangles or things like that. And I may use them in some breakout formations at times, but not to define trend, right? Not to define trend per se. John says no voice. Can everybody else hear me okay? I want to make sure everybody can hear me okay. All right, while I'm waiting, because I know there's a little bit of a delay from when I talk to when to when I come back. So yeah, pretty good for breakout trading. Okay, everybody else is good. So John, I would tell you how to fix it, but I don't really know how to tell you to fix it because you can't hear me. So, okay, good. All right. So now let's talk about swings. Okay. So swings are my preferred method for identifying trend and for determining trend. Okay. Swings are the way that I want to identify trend and determine trend. But here's the problem with swings. When you get too much into the minutia of swings, it can get very difficult. Like, for example, if looking at this chart, if I looked at this chart and said, you know what, here's my swings. Swing high, swing low, swing high, swing low, swing high, swing low, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high. That is way over the top. Because what happens here is you're not in this case, you're not really trading swings. You're trading every single candle when you do that. That's not really effectively trading a swing. Okay. So when we trade a swing, we want to trade what I used to do. And some of you were in, I've taught a lot of classes. And when I would teach this, I would tell people back, I would move people away from their computers. If I was teaching a class, I would, and people were now like leaning into their computers to see swings. What I would do is I would grab their chair and I would pull them back about 5 feet. And when I pulled them back about 5 feet was they stopped looking at every single little wick and turn and minutia of price, right? What they did was they were now able to see the general shape of price, right? The other thing that I used to do was I would reach up, because when I was teaching, oftentimes there was an overhead projector that was projecting the computer screen on the wall in the front of the classroom. And what I would do is I would on purpose take it out of focus, right? Why would I take it out of focus? Well, I would take it out of focus because I didn't want people focused on every single little turn. So for me, when I'm looking at trend, at swings, I want to take obvious swings, right? Here's an obvious swing. Here's an obvious swing. Here's an obvious swing, right? I want to use obvious swing highs and swing lows. Those are ideally what I want to do when identifying trend, is I want to use obvious swings, right? To me, these are my obvious price swings. And I don't want to overthink it at that point, right? I want to use obvious price swings to determine trend. Okay. Now, some of you may say, oh, that's a little too subjective for me. Now, there is a study that can be added to your chart. And the study that you can add to your chart, if you're interested, is zigzag percent. Most platforms have a zigzag percent that you can do. And what the zigzags or zigzag percent will do is it'll give you every couple of percentages it'll move. So I think the last time I did this, I did 2%. I made it a little bit thicker. There you go. And so this is a little bit more obvious. Every 2%, you see that it shifts. It gives it a little bit of wiggle room before some sort of a shift would occur. Now, it's not going to catch every single one, but it does help to minimize, if you will, or slow down the noise, right? The purpose here is to slow down some of the noise that you would normally be facing, right? That's really the idea. Is how can I slow down some of the noise that I would normally spot? And that's really all I'm looking to do, is to minimize some of the noise, and hopefully that makes sense to everybody. Has anybody ever used that tool? Has anybody ever thought about using that tool? Leave it in the chat box if you would, because I think it's kind of an interesting to at least consider or think about, because what that does is it helps you to kind of see things a little bit more clearly. Now, if you wanted to you can get a little bit more tight on it if you just do 1%, right? The smaller the number, the more little turns that you'll see, right? The smaller the number, the more little turns that you'll see when you put this in. And really what this just helps you to do is just kind of really just kind of not be so caught up in some of the minutia, right? Now, why is that important? Well, that is important because that's how I determine trend, okay? So when I'm looking, I prefer to use swings, okay? So now we need to talk about the definition of an uptrend or a downtrend before we can get into counter-trend trading, because we got to be able to determine trend to know if we're counter-trend trading. So let's talk about an uptrend, right? An uptrend is a continuous move of higher swing highs and higher swing lows. Pretty easy concept, right? Now let's talk about when a downtrend begins. A downtrend begins once I get a lower swing high and a lower swing low. So by definition, once I get right here, swing high, swing high, swing low. Once I get lower than this candle's low, we are now set up for a downward trend. Okay, once I get lower than that candle's low, it sets us up for a downward trend, right? So think about it. when I look at something like this, let's say I have something that looks like this. Am I in a downtrend yet? Okay. Am I in a downtrend yet? Right? When I look at that, my downtrend, couple people asking about that. Yeah, there was the zigzag tool. I'll put it back in. Yeah, Eric, is this only on the major or large time frame? Absolutely, it is. Yeah, no, I'm not in a downtrend yet, and I'm not in a downtrend because I've got a lower swing low, but I do not yet have a lower swing high. Now, if you use trend lines and you just draw a random trend line, then yeah, you've broken your uptrend. So in this case, my uptrend is getting weaker, but it's not yet been broken. How about now? Am I in a downtrend now? Right? If you think it like this, then I would now have shifted my trend direction, right? I would now have shifted my trend direction to go the other way, and now officially I'm in a downward trend because I've got that higher swing high and lower swing high and lower swing low. Okay? That's ultimately what I'm looking for in here is that my downtrend is official. Once I get a lower swing high and a lower swing low, those two things together is what creates the downward trend. Okay. Now, same thing for an uptrend. When does an uptrend begin? Well, let's say I've got downward price movement. An uptrend begins when I have a higher swing high and a higher swing low, right? Higher swing high, higher swing low. Both of those exist, and that's what creates an upward trend. Now, when looking at a trend has two types of moves. The two types of moves in a trend are impulse move and corrective move. So when looking at a trend, the impulse move is the move in the dominant direction. It's the move in the dominant direction. Okay, now this is important because this move in the dominant direction, it is persistent. Meaning you think it's going to end and it just doesn't seem to end. It will blow through opposing levels. It'll blow through opposing levels on the same or smaller time frames. This is probably the most important part of this. So it'll blow through opposing levels on the same or smaller time frames. Now, corrective moves, these are your rest periods between impulses. These tend to respect opposing levels. On the same or smaller time periods. Okay, so impulse move and corrective move. And this is really where it gets important, right? This goes back to talking about the difference between trend and curve and why I believe that trend is more important than the supply and demand curve overall. I think that trend gets more important than the supply and demand curve. First bullet says persistent. Persistent. I know PBGA. I can't write. I'm working on it, dear. You know that. That's my handwriting's not good. So I want, let's see. Ray says, can I use more than one? Yeah, you can certainly use more than one. You can use moving averages and swings. What I would say is that the swings are what you use, and then the moving averages can act as a confirmation, right? Oh yes, rest periods. That's PD is periods. So, all right. So let's look at it. Let's look at what that would look like. Let me just kind of draw it out here, right? So when I draw it out, if I were to kind of draw it out, if it's an upward trend, impulse move, corrective move, impulse move, corrective move. Now think about this. When we do this, if you think about it, what would we consider theoretically? What would this area right here be considered? What do we consider that right there? What kind of a zone would that be? Right? Just looking at that, right? It's the origin of a move down in price. What kind of a zone would we consider that to be? That would be that would be an area where in the past supply has exceeded demand, and we would think that would be a supply zone, right? And now we've put that it is a higher high, but that'd be a supply zone. So a lot of times people would consider that that's an area to sell when price returns. But because it's an impulsive move, price tends to blow right through those supply zones, right? Now, as it goes up, so now we may no longer use this as as what we would consider an area of supply, okay? We may no longer consider that as an area of supply, but you may say, okay, great. Well, I'll just wait for price to come back into this area here, which I would consider demand. And then in a really strong uptrend, what's the problem with a really strong uptrend and waiting for price to come back to here? Okay. Think about yourself for a minute, right? When you're looking at a market and the market's moving one direction and you identify a place where you want to get back in and the market's in a strong trending direction and you want to get back into that position, what is it that stops you from getting in? Yeah, it doesn't return. It doesn't always return to that level, but it for some reason it turns around, oh, I don't know, somewhere in here, right? So what you find then is, okay, it turns around because the corrective move, which that's our corrective move, it is searching out the opposing level, which in this case would be a demand level because it's going down on the smaller time period, while the impulsive move continues to blow through those areas of opposing levels, right? Now, so this is the way we think about trend. We always think about trend in the concept of impulse moves and corrective moves, right? But now we need to think about when does that trend change direction? Okay? When does that when does that trend say, you know what? I'm no longer going to go this way. I'm going to start to go that way. And how does it change direction? So, think about this guy here. We'll just call him Todd, right? Todd loves baseball. So Todd has in his hands a baseball. And Todd's got a baseball in his hand. Now Todd takes this baseball and he throws it up into the air. As Todd throws that baseball up into the air, is it picking up speed the whole way up? Or is it eventually slowing down, right? So Todd gets this baseball and it's picking up speed, but then it eventually starts to slow down. And at a certain point, this baseball stops going up. And then what does it do? It reverses direction. And when it reverses direction, what does it do on the way down? Well, it begins to pick up speed, right? This is the way we want to think about momentum, right? This is the way we want to think about momentum when we're looking at a trend. And when I'm looking at a trend, what I want to still do is consider those impulse moves and corrective moves. And what I want to be able to identify is, when do the impulse moves, corrective moves, right? As we continue to rally higher, notice at some point here, the length of our impulse move, what's happening to the length of our impulse moves each time as we continue to rally higher? Well, they're getting smaller and smaller every time as we go up. Okay. Every time as we go up, we're seeing that kind of loss of momentum. So when we see this loss of momentum, what is it that we see that may be occurring? We see that it may be reversing, right? Now, the other side of this is, not only is the impulse move getting smaller, but the corrective moves start to get bigger, right? The impulse moves get smaller and the corrective moves start to get bigger. Now, that is important because what happens is, let's say that we're looking at a 240-minute chart, okay? So when looking at our 240-minute chart, if we see that price is doing that kind of a thing where we're getting bigger and bigger corrective moves. Now, technically, I'm still in an uptrend here, but my momentum is definitely starting to slow down. All right. My momentum is definitely starting to slow down. And so I can see, okay, as my momentum is starting to weaken, that we may see a bit of a reversal. Now, this is when, though I primarily look at if I'm doing the 240, I enter on a 60, right? Now, the 240 is still in an upward trend direction. And let's say that I put in my first lower high. Technically, I'm still in an upward trend, haven't broken it. But in my 60, I might have identified. So the 60 might look more. All right, like this. In that we are still putting in slightly. Right. So on the 60, I've put in a little bit. So now I may say, you know what? Since we've put in a lower high here on the 240, I might be willing to look at this as an opportunity to get short on the 60. Now, that level that I identified there may not even show up on the 240. And technically, it would be a corrective move. Or excuse me, a new impulsive move. But if it doesn't hold on that level and we start to fall, now all of a sudden, what have I put in? A new lower swing high and a new lower swing low. And now my downward moves are my new impulsive moves, right? And now my downward trends are my impulse moves. And those impulse moves will continue to just get faster. And so I can then lean on those downward impulsive moves, shorting rallies as they come back up on the smaller time period. Typically at the start of a trend, you get one, maybe two good opportunities in that trend, right? You get one, maybe two good opportunities. After that, you don't get the same number of opportunities to kind of get back in to those positions. Now, one of the things that we can do is we can use momentum indicators to help us to see that. Okay, so what am I looking at? So the first momentum indicator that I'm going to talk about to kind of help us to see that trend reversing is the MACD, moving average convergence divergence. So first we need to talk about what the MACD is. I'm going to open this thing up here nice and wide so we can see it. First of all, before I even start this, I want to stress I do not, and the rock means do not use indicators to make my trading decisions. As a matter of fact, indicators are never going to lead price. Indicators will always lag price. And I am using the price action, the fair price value areas identified in these markets to make my trading decisions. But the indicators act as a very nice confirmation tool. right? They act as a really nice confirmation tool to give me a chance to see what I may have missed. Now, I'm going to go to a really big time period here, and specifically on the S&P, and use this as kind of a judge. And I'm going to go to a weekly chart here. Okay. Actually, you know what? I'm going to go even bigger. I'm going to go to a monthly chart, starting with a monthly chart. Okay. Now, one of the things that I want to pay attention to here is my momentum indicator and how it's being used. So what I'm looking for here is the fact that I have a swing high, a swing high, and a swing high. 3 higher swing highs. Now, this swing high corresponds to this swing high in the MACD. This swing high corresponds to this swing in the MACD, and this swing high corresponds to this one. What do we notice about my swing highs in price versus my swing highs in the MACD? Well, they are completely diverging away from one another. And that divergence away from one another. Now, first of all, MACD, this moving average convergence divergence, what the heck is MACD? The MACD is the mathematical difference. If you can see here, this says 8, 17, and 9, right? So the line's a little too thick to be able to see it. This says 8, 17, and 9. So what does that mean? Well, what it's doing is it's taking, if I were to have an 8-period moving average and a 17-period moving average on the charts, right? If I were to have them on here, it's measuring the distance between those two moving averages. When the 8-period moving average is above the 17, then our MACD is going to be, our MACD line here will be above the 0 line. When our 8 is below the 17, then our MACD will be below the 0 line. Okay? So what we're looking at here is the difference between an 8 and a 17-period moving average. Now, what is the 9? The 9 is the 9-period moving average of the difference between the moving averages. So now think about this. This essentially is an indicator of an indicator, right? That's what the 9-period moving average is, an indicator of the difference between two indicators. So you're never going to get things real time when you have the indicator doing that. And which is why you will not see me talk about using MACD to make, oops, wrong button there. Not see me using MACD to make trend decisions. There are a number of traders who will tell you that when this crossover occurs, you can go short, right? When this crossover occurs, you can go long. I just don't believe in that. However, when I can see very clearly that I have weakening momentum, okay? That I have weakening momentum. Now, in a full, as an if I'm using a monthly chart as my big picture, as an investor, am I a buyer yet, or am I still a buyer, or am I a seller as an investor? Right? Just thinking about what our price action is right at that moment. Okay? Yeah, Mike puts out a great point. You are so late to the party when you do it that way, right? But thinking about it as an investor for a moment, am I still a buyer, or have I converted to a seller? Yeah, Doug, you got it exactly, hit it right on the head. I'm not a seller yet. Okay? I'm certainly not a seller yet. And this is, by the way, why a lot of investors miss out on good, strong market opportunities, because they get too dang scared and they bail out of the market too early. You don't want to bail too early, because what happens is, just because we have slowing momentum does not mean that we're going to turn the other direction. However, it's a warning sign. Okay? Think of it like this. If you're swimming in a lake, and you're having a good old time, yay, woohoo, and then there's a bunch of clouds over here, right? Maybe they're 4 miles away. You may not have to get out of the water, but you're at least going to pay attention to the clouds, because you don't want to get shot by lightning. I love my little drawing tool, by the way. The point is that it may not come, right? This may blow the other way. It may not matter to me at all. But if it does come, I need to be aware. And this helps me to at least know I should probably pay attention. Because, by the way, this isn't the first time that we've seen this difference of momentum, right? Look, matter of fact, here we actually had a lower swing high and a lower swing low right through here, right? Well, it was actually, no, not really even a lower swing high, just kind of the same. And slowing momentum, but we didn't sell off, right? So it was really not that big of a deal because you do have those divergences that occur without price falling, okay? Now, change your time period, though, and you get a different story. Move from a monthly to a daily, right? And when I move from the monthly to the daily and I draw this thing out, what I now can do is I can say, all right, well, if I look at this on the daily time period, swing high, swing low, right? Now, even the most generous trend drawing, you have a lower swing low and a lower swing high. So even the most generous trend drawing, you are in a downward trend, right? No question. Good question about the lines and the bars. Let me get to that in just a moment because that's a great point. So, but notice before we started the downtrend, look at price was going up, but what was my momentum doing? It was going down. Let me make that momentum a little bit bigger and a little bit easier to see. As price was rallying up through here, right? My momentum was falling. So as we, oops, I don't know why that came over there. Try that again to draw on the right spot. There you go. As price through here was rallying up, that same period of time, my momentum was falling. So it wasn't a sure, a telltale sign. I mean, because notice here we had weakening momentum and price gave us another thrust higher. So it doesn't always tell us for sure what's going to happen. But let's talk about what else was occurring. As we came into this level, we were coming back right near our, let me put this back to, here we go. We were coming back right to our all-time highs, right? So if you think about it, we had rallied back to those all-time highs as we were approaching weakening momentum, right? So coming back to all-time highs with slowing momentum coming into the area, that's what gives us the idea that price is kind of, trending in that direction or may go in that direction, okay? Now, back to PBJ's question about the MACD having the lines and the bars. That they don't always have the lines and the bars. So what you're looking at here, here's the moving averages, right? The 8 and the 17, and then the MACD length is the 9. Well, what are the bars? The bars are the mathematical difference between the average. So the bars is the difference between the average of the averages and the difference between the averages, right? So the green line in this case represents the 8 and 17 period moving average difference. The purple line is the 9 period moving average of the green line. And then the bars are the difference between those two lines. So if you notice here, when the purple line is above the green line, you'll have red bars. When the purple line is below the green line, you'll have green bars. That's really the biggest difference. When the purple line and the green line cross, you essentially have no bar, right? So they cross, you essentially have no bar because that's your zero line, right? That shows me the difference of zero, right? So right now, I know that between the SPX, right? There's a 19 point difference between the 8 period moving average and the 17 period moving average, right? And then there's a 5.3 point difference between these two lines right there. That's what it's telling me. Some people will actually just use the bars, right? They'll just use the bars to kind of give them a gauge as to what's occurring. I just want to use the general shape of the indicator. Now, that's one indicator that can be used. Another indicator that can be used is you'll see people use stochastics as an indicator. Now, stochastics, it will be a little bit more reactive of an indicator than MACD. Okay, for those of you that use stochastics, why will stochastics be a little bit more of an indicator? So a stochastics essentially measures the difference between the closing price and the highest price of the last X number of candlesticks, right? And then we put a range bound of the 80 and 20%, kind of range. And so you'll hear people use the term overbought and oversold, right? How long can something say overbought? Well, it can say overbought as long as it wants. The supply and demand is still what dictates it. But if you notice, you have an area here where we started to see lower swing highs in our stochastics, and price continued to rally, but it rallied up into that area of supply. Okay. And by rallying up into that area of supply, that's where we saw the weakness kind of occur. Okay. Now you will see that there are traders that will say, okay, well, when this line crosses, that's really going to be my alert. And then when this line crosses, that's my confirmation. And then when it gets below the moving average, boom, make the trade. That works really well when you are looking at it in hindsight. When you're really trading it, it's really, really hard to do, is what I would say. So I don't often use that style. And this, very good point. Mike is pointing out that the stochastics is bound by 0 and 100, whereas MACD has a center line of 0, right? MACD has a center line of 0, and price oscillates above and below 0. Stochastics goes between 0 and 100, and it's got that 80 and 20 as the bands where you would define overbought and oversold. But these are kind of the two that are most commonly used as momentum indicators to kind of give you an additional level of support, okay? An additional level of confirmation. So when I'm looking at a position, I will oftentimes use the momentum indicator to help me to decide what I might want to do. Ultimately, the big picture tells me, am I a buyer or am I a seller? And that big picture is determined by swing highs and swing lows. And so if I'm counter trend trading, what I need to do is to identify what is my trend direction, first of all. If I'm in an upward trend, one, do I have weakness coming in that upward trend? And the weakness from that upward trend then gives me a potential for an entry, as price can then come back off of that level and come back off of that area. That's ultimately what I'm looking to do, okay? And so then I can get in on the smaller time period level, and getting in on the smaller time period level will allow me to, to kind of take advantage of that particular move. Okay. All right. So that's really ultimately what I want to look for. So for example, let's pick a GBP USD. Let's pick a currency pair. And let's go to a 4-hour chart. Let's get rid of all my indicators here. I'll leave my MACD on here for a minute. Okay. So looking at my indicator here, first of all, what is my trend direction? Do I have a defined trend direction in here? Well, right, when I'm looking at this, if I'm looking at my swing highs and my swing lows, do I have a truly well-defined trend direction? What do you guys think on there? Do you think it's an upward trend? Do you think it's a downward trend? Do you think that it is an undefined sideways trend? Tell me what you think about this one. And I know there's a little bit of a lag between when I talk and when you hear it. So I'll give you guys a second to type it into the chat box. Okay, so down. Doug says that it's down. Phil says that it's down. Okay. Angelo says down turning sideways. All right. Okay. Now, I think I would most likely agree with Angelo, but what's one of the other things that we can use to help us see that our downward trend is losing a tremendous amount of steam? All right. What's one way that we can see that our downward trend is losing a tremendous amount of steam? Well, I can see the fact that on this swing low, here was my MACD position. On a lower swing low, here's my MACD position, right? So I'm starting to get this opposite directions, right? Telling me, okay, there might be an opportunity here. Now, does it mean that there is an opportunity here? Heck to the no. There may still not be an opportunity to get into a trade, but it at least gets my ears perked up, right? It at least gets my ears perked up. So now what I can do is say, well, let's take it from the 4 hour to the 1 hour. And I can look at it on a 1 hour time period. And now looking at it on a 1 hour time period, I can make a determination that says, okay, is there an area of demand where I can step in and be a buyer? And as I look at this chart, there's really nothing I like that tells me I can be a buyer. However, I definitely see that there's a potential for a breakout above one of these areas. Okay. Now, knowing breakouts will help you a ton. Those of you, I know not all of you on here are trading breakouts because maybe that's not a style that you learned. I would tell you if you want to really get somewhere in your trading, you're going to want to learn how to trade breakouts. To me, breakouts, especially in strong trending markets, breakouts become the absolute best way to re-engage a strong trending market. I will take breakout trades, frankly, with more confidence than I will take reversal trades, which I know is not what's the word I want to use? Is not comfortable for a lot of people out there, right? A lot of people have been kind of shied away from breakout trades, but this to me could be setting up for an upside breakout that could allow somebody to get long somewhere up above this region, primarily because we've got a level here that we've already touched and gone through, touched it again. If we can kind of base below there again, then that becomes a really, strong area to kind of get back in. So keep an eye on breakouts when you have this area, because sometimes that's the way you'll get in on your trend reversal styles, right? Is being able to kind of do it inside of there. And you might even go candle to candle style on some of this, where you've got that candle to candle style of trading. And for those of you that are not familiar with candle to candle trading, if it's something that you have not seen, if you go to Traders Army, go to the website under tradersarmy.com. We have the free trading videos. I don't have time to get into candle to candle style of trading here, but here's a 20-minute lesson on candle to candle trading. So you can kind of go in there and take a look and see, how to do that. But that's another way to get in on some of these positions a bit earlier so that you can kind of take advantage of them. So, all right. Whew, I feel like I covered a whole bunch of stuff tonight. I went a little bit longer than I originally meant to. Real quickly, I wanted to let everybody know we're going to be taking as many questions as we can. For those of you, I know a lot of you watch our daily market commentary, and a lot of you are subscribers to tradersarmy.com. So those of you that are subscribers, I'm glad you're able to make it in tonight. Those of you that are not, feel free to go to tradersarmy.com and take a look around, see if it's something that you want to be a member with and learn a bit more. But I want to open it up for questions right now. So wide open question and answer period. I think I got all the questions in the chat box so far, but I want to open it up for questions. Feel free to type in anything you want, so long as you're nice to everybody and be nice to me. No trolls in here, man. But I think I tried to get most everybody's. I will show the tool that I used one more time, because I think I did miss that. So the tool that I used for determining trend, let me bring this back up here and let's go to a stock. The tool that I used, if you go to this platform, it's called Zigzag Percent. So it is Zigzag Percent, and then I set it to the default is 8. I set it, the lowest I set it was a 1%. You can actually go lower than that if you want. It'll give you a few more swings. You could even go 0.5% or whatever you want to do. You need to figure out you need to figure out what makes sense for you, right? Based on your style. Go 0.5%, you're going to get more swings. You go 2%, you're going to get less swings. Okay. So that's a really nice tool to be able to just see swings very quickly and very easily. Question from Angelo. Thoughts on RSI as a momentum indicator. So RSI as a momentum indicator, I think it's okay. I don't really use RSI all that much. So I can't give you a tremendous amount on it. When I look at it, what's funny is the indicators that I used to use a lot, I'd kind of memorize exactly what to do and how they worked. And I even knew the math on how they were calculated. RSI is not one of them that I did. And I know that there's the 70-30 line, overbought, oversold. And I know that in a strong downtrend, technically in a strong downtrend, you might want to move these 70-30 down to 60-20. And in an uptrend, you might want to move it to 40-80. Because you're not going to get very many overbought conditions in a strong downtrend to let you get back in. But I am not a huge, proponent of this one, only because I don't know enough about it to give you an educated answer. I'd love to, because it's just not one I've ever jumped in and used. So I'd hate to give you something that I'm not an expert in that area, Angelo. But I'll do this. I'll research it a little bit. And then if you shoot me an email, support@tradersarmy.com, and I will try to get you an answer once I've read through it a little bit. How's that? Let's see. McMoney 135. How much risk is buying the pound right now? So I'm going to give you the best answer that I can give you is the risk in buying the pound right now is the same that it always is. It's the risk that you control. I am a big fan of you are the one who controls your risk through the use of stop losses. Now, the difficulty is that with these, with these currencies, you can have some of these big shock loss events, right? These big shock movements. But realistically, your stop should still be in play, right? It's very, very rare that you're going to get completely wiped out. And so if you're talking about buying the pound, going long the pound dollar at this point from a longer term perspective, if I look at this from a longer term perspective, first of all, when the UK leaves the Eurozone, the UK is not closing for business, right? We've seen the pound was already, it's just been decimated, right? Just completely fallen apart well before Brexit, right? It was having a big move down before Brexit happened. I was actually in London the day of the Brexit announcement, which was really an interesting time to be there. I was there the day that the announcement occurred. And what's funny is that we actually were way worse off before that, when it got there. So where it stands now to me is that I think a lot of that movement has been priced in. I do believe that if I look at this on a weekly chart, right, we're looking at longer time periods here. We're sitting at a bit of an inflection point. And if I, just talking about our momentum, if I throw my momentum back on here, we do see that we've got fairly weak in the momentum category, right? Are definitely in a stronger position for a downward trend. We've already hit this level once, got a nice move away. We're now hitting it a second time. This move away was fairly weak. So I am definitely more bearish than I am bullish, right? McMoney's screaming at me. Of course, stop loss. I'm more bearish than I am bullish. But I am, longer term. But ultimately, when I look at this, I'm not overly concerned with a tremendous amount of overexposure if I decide to buy it, right? I wouldn't buy it at this point from an investor standpoint. From a trader standpoint, you're certainly going to get smaller time frame opportunities. Okay. chance to fill that wick. That wick, are you speaking about on the weekly time period? Are you talking about this big old wick back here that occurred on the Brexit announcement right through there? Because that's the big wick, right? That was the one that occurred, I think, in a day that it shot up and then came screaming back down. I think the chances to fill that wick in the next few weeks or months are very, very, very slim. I don't see in my zone. So this area down here, this long wick right there, I think it's a very strong chance to fill that wick. In fact, I believe it's probably a probability to fill that wick. I think that would probably fill and frankly continue to blow through. My overall outlook is definitely more bearish than it is bullish. And frankly, it looks like it's setting up for potential breakout to a breakdown from that zone. Now, if price does, for some reason, get us a little rally, there is definitely some smaller time frame opportunities in here. The one I like the most being this one up here. This would be the one that I am most intimately drawn to if we get some sort of a rally. This is the one that kind of sticks out to me more than all the rest. Primarily because this is a fair price value area where we saw a bit of a reversal through here in the past. It was the origin of a little bit of a speed candle in this move higher. And that typically tends to oftentimes be magnets for price. So that's what I would look at there. All right. Hopefully that answers your question. Let's see. Rajwant Singh Combo says, what do you think of Elliott wave patterns? I think Elliott wave patterns. Nope, I'm talking about them right now. What do I think about Elliott wave patterns? So one of my problems that a lot of people love me for and hate me for is the fact that I am always brutally honest. I believe that Elliott wave patterns work really, really well when you look in the past and determine where those wave patterns existed, right? Everybody who shows you Elliott wave in the past. And they show you, look, here was 1, 2, 3, 4, 5, A, B, C, and look how well it worked. Got it. The problem is when I look at this, all right, like, so here's my chart. Okay. Let me get rid of my indicators here just to kind of clear things off. And this goes for every single person I've ever seen show me Elliott wave. There's always justification as to, well, here is wave 1, 2, 3, 4, and now we're on wave 5. Or they say, no, wait, no, that's not right. No, that's not right. This is inside of there is wave 1, 2, 3, 4, 5. That's really just wave 1. And then here's wave 2, which is A, B, C. And then wave 3 is this 1, 2, 3, 4, 5. And so what happens is, or somebody else will say, no. This is wave 1, 2, 3, 4, 5, A, B, C. It's, to me, it is too subjective to use. In my humble opinion, for what it's worth, I think that most people who use Elliott wave go back and make Elliott wave fit their story. That's what I've always seen. And I feel bad saying that because I know a lot of people really lean on it and really think it's amazing. And maybe for them it is. For me, every single person I've ever seen try to show it to me and use it winds up having to justify why they picked those turning points that they picked later on. And very, very infrequently does it help them going forward. Matter of fact, I used to teach to a trading group in Phoenix, Arizona. It was a big group. It was a great group, a lot of really great people. And they all used Elliott wave. And there was like 150 of them or 200 of them. And they were super nice people. And it was an options user group that used Elliott wave as their main trading technique to identify turns and trends. And they knew a ton about inverted diagonalized collars, and they could tell you all about upside down purple butterflies. And they knew so much about options, it was crazy, but they weren't making any money. And they weren't making any money because they were trying to use Elliott Wave and they were getting killed. So that's my belief on it. So I hate to, I don't want to rain on anybody's parade, but that's just me. If somebody else can show me, then I'm willing to listen. I'm always willing to listen and to do a bit more on there. So, that being said, what I want to do is, I've been over an hour, and I promise you I would try to get this done in an hour or so. I really, really appreciate you guys taking the time to join me. I feel blessed that I got a platform that I can come on and speak to you. And if you guys like what we talk about here, we do live Q&A sessions at tradersarmy.com every week. So for those of you that are interested in learning more about Traders Army, go to tradersarmy.com. I know there's some members that are in the chat box tonight. If you guys want to hear, let the members tell you that some of them that are with us, we become a pretty good family. So I love to have you guys. I love to have you guys. Feel free to join us and learn a little bit more about what we do. But that's all I have for tonight. Sue, good to hear from you. Great to see that you made it in. So, I'm glad you get diversion. I'm glad that you're getting it now. So that's awesome. So, all right, everybody. Well, I hope you guys have an amazing day, and I will see you on the Daily Market Commentary tomorrow. Peace out. And then Traders Army members, remember, we have a live Q&A session tomorrow night. So make sure your microphones are working, make sure your cameras are working, and I will see you tomorrow night on the session. Thanks, everybody. See ya.